Well, oil prices cooling off a bit today, but they are still up 29% for the month, helping to put pressure on the major averages. Could the latest push higher in oil prices force the Fed's hand? Joining us is Warren Pies from 314 Research. Warren, it's good to see you.
Nice to see you. Thanks for having me.
So, oil rates, they've gotten back on the radar, and it's very relevant for stocks because, as you point out, you've had this kind of rotational market, very low correlations among different parts of this market. The indexes have been kind of stuck, but basically the market has basically found a way to hang in there. But you say that leaves it vulnerable to a macro shock. Do we have something like that brewing?
Potentially. I mean, that's an unsatisfying answer. Our recommendation to clients is that to account for that risk, you'd have to be overweight commodities. I mean, really going back to the beginning of the Iran war and through it, we're saying we like equities, but the big risk here, as you point out, is another flare up in this unpredictable conflict. And the time's not on the side. The longer this goes, the farther global inventories drain, and obviously, if you have a long position, you're benefiting from backwardation. So we're pairing an overweight commodity with overweight equity position. I think the reason it's so scary, it's not just about the consumer and how oil hits the consumer, but how it's impacting the Fed and leading to next week's meeting and then into September. I think it becomes a real risk factor if oil doesn't cool down, that the Fed starts considering a hike. I don't know that I agree with that decision, but the political pressure is real.
I was going to say, it could be a long wait. Obviously, there's an unusually, large gap between July and September meetings. And then if, in fact, you're sitting there on inflation watch the whole time, the bond market's getting, uneasy further about that, it could force the Fed's hand. But then would that be a mistake if the Fed were to move toward tightening now?
I tried to not be normative, but my honest opinion is, I wouldn't be hiking here. I think that wage growth is decelerated. I know we've had 3 straight months where the labor market looks a little bit better, but I think under the surface you're still getting negative revisions in the housing market, which is the most responsive area of the economy to interest rate policy, is in basically a recession at this point in time. And so I don't think there's any real inflation pressure from the areas of the economy that the Fed can touch. So where are we getting inflation pressure? We have a supply outage in the Middle East. It's just straightforward, classic academic knowledge that you don't hike into a supply-induced spike. So I don't think that's a good reason to hike. And then you have the AI build-out. And I don't think a hike or two is going to stop the CapEx plans of the hyperscalers. And so ultimately, I think it would be a mistake. You're just going to depress these responsive areas of the economy further.
All that being said, you still say overweight equities, still a bull market. This whole low correlation story, the percentage of days where the index goes one way and the majority of stocks go the opposite direction. It feels like both the biggest story in the stock market and also one that it's like everybody's watching this pot. Is it really going to boil? I mean, what's the upshot here? And it's just the market's way of kind of resetting below the surface.
Yeah, I think it is. I think that the number one key here is, well, first, let's step back and just realize the amount of damage that's under the surface. We've had the average S&P stock is down more than 18% from a 252-day, 1-year high. And so there is a real correction happening. I mean, the real exhibit A for that would be the semiconductor group. Even in the cap-weighted NVIDIA-dominated group, that's down like 13%. If you look at SMH or SOX, it's down way more than that. And so I think we have corrected a lot of that. And then we're going into earnings season. And the big stat to me is like, yes, correlations are low. We're vulnerable to a macro risk because of that. But on the other hand, this really important semiconductor group enters this earnings season with the highest implied volatility that we've seen for any earnings season outside of the GFC. To me, that's a really high hurdle for the bears to push this significantly lower. So I like playing those odds. I think semis can get back into gear during earnings season and reverse really this momentum rotation we've been playing since really like mid-June.